Welcome to our comprehensive guide on understanding business structures. In this video, we'll explore the foundational types of business organizations, their unique features, and how they impact everything from daily operations to long-term growth. We'll start with real-world stories like how Kinko's began as a small copy shop and evolved through partnerships and mergers. By the end, you'll have a clear grasp of sole proprietorships, partnerships, corporations, and limited liability companies, as well as the strategies businesses use to merge and grow. Let's dive in and discover which structure might be the best fit for your entrepreneurial journey. Before we get started, let's outline what you'll learn in this chapter. You'll be able to list the advantages and disadvantages of sole proprietorships, partnerships, corporations, and limited liability companies. You'll also learn to distinguish between general and limited partners, compare C and S corporations, and understand how businesses can merge or acquire others. These objectives will help you make informed decisions about starting or growing a business, whether you're an aspiring entrepreneur or simply curious about how companies are structured. Let's begin with a true story. In 1970, Paul Orfalea, a 22-year-old college student, opened a tiny copying service near the University of California, Santa Barbara. With just one copier, Kinko's quickly became a hit among students. To expand, Orfalea set up his business as a partnership, allowing others to buy in while he maintained control. However, each partner ran their store differently, leading to inconsistent customer experiences. Eventually, Orfalea sold part of the business to private investors who centralized management and standardized services. Later, Kinko's merged with Federal Express, becoming a one-stop shop for business professionals. This story illustrates how business structures and strategic decisions can shape a company's success. Businesses come in many forms. Some are owned by a single individual, while others have multiple owners or are even considered separate legal entities. The structure you choose affects everything from legal protection to taxes and growth potential. For example, LA Fitness is a limited liability company, Great Clips is a corporation, and some accountants operate as limited partnerships. Understanding these differences is crucial for anyone looking to start or invest in a business. Throughout this video, we'll break down each structure's unique features and help you see how they fit into the broader business landscape. The sole proprietorship is the most common business structure, even though it accounts for only a small percentage of total business sales. As the name suggests, it's owned and operated by one person. The owner and the business are legally the same, meaning all assets and liabilities belong to the owner. This structure is popular because it's easy and inexpensive to set up. If you want to start a small business quickly, a sole proprietorship is often the simplest route. However, this simplicity comes with important trade-offs, especially when it comes to liability and funding. One of the biggest advantages of a sole proprietorship is how easy and economical it is to start. You only need to deal with one person, the owner, making transactions and decision-making straightforward. Taxation is also simple, as profits are reported as personal income. The owner enjoys a high degree of flexibility and privacy, running the business as they see fit without having to share information with partners or the public. Plus, it's just as easy to close the business as it is to start it, offering unmatched convenience for small-scale entrepreneurs. Despite its simplicity, a sole proprietorship comes with significant drawbacks. The owner is personally liable for all business debts and legal actions, meaning personal assets like a car or home could be at risk. If the owner dies, the business dissolves, making it difficult to ensure continuity. Funding is also a challenge, as banks are hesitant to invest in businesses so closely tied to one individual. Most sole proprietors rely on personal savings and credit to get started. These risks make it essential to weigh your options carefully before choosing this structure. Consider Amanda, a stylist who decides to open her own salon. She chooses a name, files paperwork, gets a business license, and opens her doors. All profits are reported as her personal income, and she can use her own credit cards for business expenses. However, Amanda is also personally responsible for any debts or legal issues. If a customer slips and falls, Amanda's personal assets could be at risk. This example highlights both the ease and the potential dangers of running a sole proprietorship. A partnership is a business owned by more than one person. Like sole proprietorships, partnerships are easy to form, often requiring just a verbal or written agreement. Partners share profits, losses, and liabilities, which can be both a strength and a weakness. Multiple partners can pool resources and expertise, but each partner is also responsible for the actions and debts of the others. Partnerships offer flexibility and privacy, but they also require trust and clear agreements to avoid conflicts. Partnerships make it easier to share startup costs and bring together a wider range of skills and expertise. They are simple to set up and dissolve, and they offer flexibility in management. Taxation is straightforward, with profits and losses passing through to the partner's personal tax returns. Partnerships can also be more attractive to potential investors than sole proprietorships, thanks to the combined resources and talents of multiple owners. However, partnerships also come with risks. Each partner has unlimited personal liability, meaning one partner's mistakes can affect everyone. If a partner wants to leave, they need approval from the others, and the business may dissolve if a partner dies. Disagreements can arise over management decisions, profit sharing, or business direction. To avoid conflicts, it's wise to create a detailed partnership agreement outlining responsibilities, ownership percentages, and dispute resolution methods. Imagine Amanda decides to open her salon with two coworkers. They share startup costs and responsibilities, but also risks. If one partner makes a poor business decision, all partners could be affected. To protect themselves, they draft a partnership agreement specifying each person's investment, profit share, and duties. This agreement helps clarify expectations and provides a roadmap for resolving disputes, ensuring smoother operations. Not all partners are the same. In a limited partnership, some partners are general partners who manage the business and have unlimited liability, while others are limited partners who invest money but don't participate in management. Limited partners are only liable up to the amount they invest. There are also limited liability partnerships, LLPs, where all partners have some liability protection. LLPs are common among professionals like lawyers and doctors, offering a balance between shared management and personal protection. A corporation is a business that is legally separate from its owners. This means the corporation itself is responsible for its debts, not the individual owners. Corporations can raise money by selling shares of stock, making it easier to fund growth and expansion. Owners, known as shareholders, have limited liability. They can only lose what they invest. Corporations can be public, with shares traded on the stock market, or private, with shares held by a small group. This structure offers strong protection and growth potential, but also comes with more regulations and complexity. When a corporation is formed, ownership is divided into shares of stock. Shareholders own these shares and have certain rights, such as voting for the board of directors and receiving dividends if the company makes a profit. There are two main types of stock: common stock, which comes with voting rights, and preferred stock, which offers priority for dividends but usually no voting rights. The board of directors oversees the company's operations, making key decisions and ensuring the business runs smoothly. Corporations can be public or private. Public corporations sell shares to the general public and must disclose financial information to investors. Examples include Google and Harley-Davidson. Private corporations, on the other hand, are owned by a small group and don't have to share financial details publicly. This distinction affects everything from funding opportunities to privacy and regulatory requirements. The process of selling shares to the public for the first time is called an initial public offering, or IPO. Forming a corporation offers several advantages. Owners have limited liability, meaning their personal assets are protected. Corporations can raise large amounts of money by selling stock, making it easier to grow and innovate. The business continues even if owners change, providing stability and longevity. However, corporations are more expensive and complex to set up, with strict legal requirements and less privacy, especially for public companies. Entrepreneurs must weigh these factors when deciding if a corporation is the right choice. Despite their strengths, corporations have drawbacks. They are harder and more expensive to set up, requiring legal help and ongoing compliance with regulations. Public corporations must disclose financial information, reducing privacy. There's also the risk of losing control if someone buys a majority of shares. Finally, corporations often face double taxation. Profits are taxed at the corporate level, and shareholders pay taxes on dividends. These challenges make corporations best suited for businesses seeking significant growth and investment. There are two main types of corporations: C corporations and S corporations. C corporations are the traditional model, featuring double taxation, unlimited shareholders, and open ownership. S corporations, created to help small businesses, offer pass-through taxation like partnerships, but are limited to 75 shareholders and must meet strict ownership requirements. S corporations are often chosen by small businesses that want liability protection without the burden of double taxation. However, if a business expects to grow large, it may eventually convert to a C corporation. C corporations are independent legal entities with no limit on the number of shareholders. They can raise capital easily and are set up for growth. However, they face double taxation. Profits are taxed at the corporate level, and shareholders pay taxes on dividends. C corporations are subject to strict regulations and must disclose financial information if they are public. This structure is ideal for medium to large businesses looking for expansion and investment opportunities. S corporations offer pass-through taxation, meaning profits and losses are reported on the owner's personal tax returns, avoiding double taxation. However, S corporations are limited to 75 shareholders, and ownership is restricted to individuals, estates, or certain trusts. Other businesses and foreign investors cannot own shares. If these rules are violated, the company can lose its S corporation status and face tax penalties. S corporations are best for small businesses seeking liability protection and simpler taxation. A limited liability company, or LLC, combines the best features of partnerships and corporations. LLCs offer pass-through taxation, so profits are taxed only once, and they protect owners' personal assets from business debts. Owners, called members, can participate in management while maintaining liability protection. LLCs are flexible, allowing members to divide profits and responsibilities as they choose. This structure is popular for small and medium-sized businesses seeking both protection and flexibility. LLCs offer several advantages. Members have limited personal liability, protecting their assets from business debts. There's no limit to the number of members, and the business can continue even if an owner leaves or passes away. LLCs are flexible in how they distribute profits and manage the company, and they enjoy simple pass-through taxation. These benefits make LLCs a popular choice for many entrepreneurs. Despite their advantages, LLCs have some drawbacks. They are more expensive to form and operate than sole proprietorships or partnerships, though generally cheaper than corporations. Finding funding can be more challenging, as LLCs cannot issue shares of stock. Some legal uncertainties remain about how well LLCs protect against liability in court, though they generally offer more protection than sole proprietorships or general partnerships. Entrepreneurs should consider these factors when choosing a business structure. Suppose Amanda wants liability protection but doesn't want the complexity of a corporation. She and her partner, Jody, could form an LLC. This would allow them to split profits based on their investments and manage the business as they see fit. They enjoy personal asset protection and flexible management, making the LLC a strong option for small business owners who want both security and control. Let's compare the four main types of business structures: sole proprietorships, partnerships, corporations, and LLCs. Each has its own balance of simplicity, liability protection, funding options, and flexibility. Sole proprietorships and partnerships are easy to start but offer less protection. Corporations and LLCs provide liability protection but come with more rules and costs. Your choice will depend on your goals, resources, and risk tolerance. When deciding on a business structure, consider factors like how many people will own the business, how much control you want, what personal assets are at risk, tax advantages, ease of formation, and funding options. Think about your comfort with handling marketing and accounting and whether you want the business to continue if you leave. There's no one-size-fits-all answer, so weigh each option carefully to find the best fit for your goals. Let's review what you've learned. What are the pros and cons of a sole proprietorship? Remember, it's easy and cheap to start, offers full control and privacy, but comes with unlimited personal liability and limited funding options. The business ends if the owner dies. These trade-offs are important to consider before starting your own business. Now let's look at partnerships. They're easy to start, allow for shared costs and talents, and offer simple taxation. However, all partners have unlimited liability and the business may dissolve if a partner leaves or dies. Disagreements can also arise, so a clear partnership agreement is essential. Understanding these pros and cons will help you decide if a partnership is right for you. Corporations offer limited liability, strong funding options, and business continuity, but are harder and more expensive to set up. They face double taxation and must comply with strict regulations. Public corporations lose privacy and risk hostile takeovers. These factors make corporations best for businesses aiming for significant growth and investment. LLCs provide limited liability, flexible management, and pass-through taxation. They can have unlimited members and continue if an owner leaves. However, they are more expensive to start than sole proprietorships or partnerships and may face challenges in raising funds. These pros and cons make LLCs a balanced choice for many small businesses. Let's test your knowledge. If you enter a partnership and participate in management, you have unlimited liability and are considered a general partner. Limited partners, on the other hand, invest money but don't manage the business and are only liable up to their investment. Understanding these roles is crucial for anyone considering a partnership. In a sole proprietorship, owners run the risk of losing personal assets if sued. This is known as personal liability. It's a defining feature of sole proprietorships and general partnerships, making it essential to understand the risks before starting a business under these structures. Which is not a characteristic of a C corporation. C corporations feature double taxation, independent entity status, and limited liability, but they are not a form of limited partnership. Knowing these distinctions helps clarify the differences between business structures. If you want to keep shareholders under 75 and have pass-through taxation, an S corporation is your best option. S corporations are designed for small businesses seeking liability protection and simpler tax treatment, but with restrictions on ownership and size. If you want the liability protection of a corporation but more flexibility in management, a limited liability company, LLC, is a great choice. LLCs combine the best aspects of corporations and partnerships, making them ideal for many entrepreneurs. To stay competitive, businesses often merge with or acquire other companies. Mergers combine two companies into one, while acquisitions involve one company buying a controlling interest in another. These strategies can help businesses grow, adapt to new markets, or gain new resources. However, they also come with risks and challenges, especially when it comes to integrating different corporate cultures. There are several types of mergers. Horizontal mergers occur between companies producing similar products, reducing competition. Vertical mergers happen between companies at different stages of production, like a supplier and a manufacturer. Conglomerate mergers join companies in unrelated markets. Consolidation creates a new company to purchase the merging firms. Each type has different strategic goals and challenges. An acquisition happens when one company buys enough stock to control another. Most acquisitions are friendly, but some are hostile takeovers where the target company's management opposes the sale. Hostile takeovers can be disruptive, leading to changes in management, layoffs, or asset sales. Some investors, like Carl Icahn, specialize in these aggressive strategies, aiming to increase company value and profit from the changes. Companies can use several strategies to defend against hostile takeovers. Shark repellent involves convincing shareholders to vote against the takeover. A poison pill makes it harder for a raider to gain control by issuing new shares at a discount. Golden parachutes offer lucrative exit packages to executives, making the takeover more expensive. A white knight is a friendly buyer who acquires the company before the raider can. These tactics help management protect their company from unwanted takeovers. Despite their potential, most mergers and acquisitions fail to increase company value. Common reasons include poor integration, overpaying for the target company, and clashing corporate cultures. For example, when Daimler-Benz merged with Chrysler, differences in management style and employee expectations led to confusion and lost productivity. Reconciling different corporate cultures is crucial for a successful merger. A leveraged buyout, or LBO, occurs when buyers use borrowed money to acquire a company. The expectation is that the company's profits or asset sales will repay the debt. LBOs are risky because of the added debt, but they can yield high returns if successful. Often the company is taken private to allow for more control and restructuring before potentially going public again. This strategy has made fortunes for some investors, but it's not without significant risk. Not all business combinations are permanent. Strategic alliances are long-term partnerships to develop, produce, or sell products together, allowing each company to focus on its strengths. Joint ventures are short-term collaborations for specific projects. These arrangements let companies share costs and test compatibility before considering a full merger or acquisition. For example, AOL and Google formed a strategic alliance to improve their services and share profits. Choosing the right business structure depends on your goals, resources, and risk tolerance. Sole proprietorships are quick and easy. Partnerships share responsibility. Corporations offer liability protection and growth potential. And LLCs provide flexibility and security. As you move up the ladder from sole proprietorship to corporation, you trade simplicity for protection and funding options. Consider your priorities and consult professionals to make the best choice for your business. The business world is fast-paced and full of opportunities. Many giants like Disney and Apple started in garages with little more than a good idea and determination. With the right structure and strategy, you too can build a successful business. Remember, every structure has its trade-offs, so choose wisely and stay adaptable. Good luck on your entrepreneurial journey.